I thought you actually meant like, well, we just don't want to cover price because that's just like everyone's just looking at price and we're not looking at the important topics. And if it was that, I would understand it and I would counter argue because I don't do what I do because of price. I do it because like if Bitcoin's going to make impact, it needs to grow in its market cap so it's large enough to swallow the world's economy. And the best thing I do, because the best thing I can do in the skills I have and the reach I have so far is really just get that out to investors. So when they look at it, this is like, oh, that's a legitimate investor. That's an legitimate investment. There's fundamentals behind it. It's not all like Dogecoin memes, and there's some data behind it, and that no, I'm not going to sell because the latest FUD round from whatever Bloomberg article comes around. And so that's what I think my role is to provide retail, not institutional, but retail access to high quality analysis that can understand the investment they're in, and then it can help that market cap grow and more people would come in with confidence so that it's big enough to make some meaningful impact on the world economy. I thought I worded it correctly. People just thought it was hugely bearish. I see it as medium-sized bearish in the short term, but I didn't talk about the outer bullish environment that it's in because I just said it's unchanged from the last letter. So that kind of maybe people don't see the bullish note on it. Because that was a very fast to put out letter because it was very timely data. It only happened within 24 hours, and we've since seen it pull back. But I wanted to get it out there because the data was there, and I didn't have time to cover the normal macro and all that stuff. This is like a fast alert, and if you want the bigger macro, then go to the last letter. And it is bullish. It's obscenely bullish. So this was just to document what's already somewhat played out. So it's no secret, this pullback, it's yet to see how deep it pulls back, but I don't think it's going to be that major. It's kind of medium. But the greater environment's amazing. We've never seen this structure before. Like, gosh, every bottom of a bear market, there's an accumulation band. The latest research that I've been doing is riffing off some of the stuff that Will Clemente created, which is a ratio, of a bunch of coins that people the Rick Astley is the ratio of Rick Astley, who doesn't ever sell
Never gonna keep
to DGen Trader, right? DGen Trader and Rick Astley, who's got more coins. You run the ratio and you get this, what I call a supply shock. And it's a ratio of like the coins that you're not going to get, bro, versus the coins that you might be able to get, right? So the more coins you cannot get versus, as that grows, the price usually goes up. So you run that ratio and it tracks price very closely. And this is where you can go, wow, it's going down, the price is going up, then price has got to come back down because the demand and supply between Rick Astley and DGen Trader is moved the other way to DGen, who are going to buy and sell and short the market, So it's actually just a method of demand and supply, because you have to figure what are the coins you cannot buy versus the coins you can buy. And you can do different things like what's in cold storage that's not on exchanges versus on exchange, because you probably can buy the coins that are sitting on exchanges. You're not going to be able to buy the coins sitting in cold storage, right? So that could be another view. But there's an interesting view that the Glassnode guys do, which is they look at the coins that date beyond 155 days, 5 months. If they've been sitting in wallets 5 months, we call that long-term holders because they haven't moved those coins in 5 months. The short-term holders, they're moving back and forth. But once they graduate into 5 months, we consider them long-term. So you can do that ratio of long-term holders, you can't buy their coins, versus short-term, which is below that threshold. And that's a really slow-moving graph because the other stuff is reactive. You can trade over the weekly cycle, but this stuff is macro. It takes 5 months for a long-term holder for us to figure out that's long-term. So it's very smooth charts, and every single bottom of the bear market, you see that peak. The long-term holders are at maximum accumulation. They've got the most of the coins. And then as the market runs up, they start to divest and they take the profits, and the short-term guys start to buy in because they're the new guys in there. And so when the long-term holders start to lose their supply of the coins, that starts to approach a top, right? But this is a macro cycle thing. So you see it, you would have saw it at the 2015, 2014 bottom. You saw it at the 2019 bottom. And actually you saw it over the 2020 where we came back down. There was COVID crisis. There was Michael Saylor scooping up all the coins. And that was another peak of long-term holders accumulating. And we're moving into a peak, and we'll be at a peak at current rates by next month. And that means peak accumulation, right? Peak accumulation means that's defining this kind of sideways band, and then after that, we do a run-up. Like the last run-up was 10,000 to 60,000, starting from October last year. The run-up before that was from 4,000 to 14,000 over a matter of months. So if October we start to peak and we don't know how long that accumulation band is, we're starting to look into November onwards to go, that's when the run-up happens. That's like all the coins are being scooped up by these long-term guys, and November's when the ETF launches, is like what the SEC is making comments about. We'll probably release or allow an ETF around November timeframe. Well, even if that doesn't happen, whatever the policy is, but just the structure of the market is like, this thing is going to go nuts. We're now going to approach into November, December with all these coins locked up by the long-term guys. And we know that when that happens, price is going to do a run-up, like the 2017 run-up, the first part of this year run-up. And I'm like going, whoa, we're underpricing this bull market into 2022 because everyone is thinking 4-year cycles. And it's like, we're breaking the 4-year cycle. Yeah, exactly. And, it's the 4-year cycle is that 1 year, and it's just horrific, right? And people thought, is it a 4-year cycle? Is it a lengthening cycle? But I'm like going, no, it's either a 4-year cycle because we're locked into the gravity of Bitcoin's miners in the hardening cycle. And then there's a macro cycle, which, these are gravitational pulls, and it's going to we're going to go 4 years, or we're going to get pulled into the macro economics, which is roughly 10 years. And we're going to go binary to being correlated to any other world asset. It'll be like that. And so if we break this, and let's say it doesn't start caving in 2022 and it just falls back into another 4-year thing, but the demand and supply is sufficient for that escape velocity, and all of these complications and interactions of the new Bitcoin ecosystem. Really, it was very simple before. It was just miners halve the amount of dumping onto the market, and that's the impulse. Now we've got volatility impacts, how much volume is traded. Those kind of impacts impact how much is selling on the market, because those infrastructure guys dump, right? Because they dump their collected Bitcoin revenues and fees into the market. ETFs are the same. They collect their thing, their fees, they dump it on the market. So there's this very complex interaction now. And so one thing that I can see is highly probable is that, when I think of cycles, I think about the x-axis, the time component, which is 4 years. And I was interested to see if these super cycles, we skip a cycle and we come back. It's an 8-year bull run, and then we come back. And but I think what's happening is that we break the 4-year, and once we break it, it's essentially like this thing that's reached escape velocity, and we're no longer pulled into the 4-year mining cycle. And you can see it already. The price is doing this drunken wander of price discovery, and it's not these nice parabolics we saw before. And I think we just wander. We just keep wandering up and down as Bitcoin adopts and gets to saturation. Without these, 50% was the last pullback, which we just had. And that was the last one. That's a good kind of barometer of what we can expect in the future, and it'll get less and less and less. And then we have these correlations to macroeconomics. So that's it. That's the big revelation, is that's the first solid bit of on-chain data-driven suggestion that we've reached escape velocity. That's getting me pretty excited, and I'm going, whoa. I looked at the options market, and I was seeing what these call options were, making a bet out into 2022 of what Bitcoin price will be. And I'm going, well, seems pretty undervalued based on these new models. And I'm like going, yeah, the market's not pricing this in yet. I don't think they are. The latest stuff we can see in the data between the investors is that it's not going to repeat. And this cycle is not a 2013 double pump and a blow-off top. This is completely different. This is the new 2020 onward cycle, which we've never seen before. And I mean, even at the start of this year, I see the structure is completely different from 2013. Like, you can look at price and you go, oh yeah, it's going to be a 2013. But if you look on chain, it's like a completely different structure. Never seen it before.
We hope that you have enjoyed this insightful video report. Please give it a like and do share it with your friends. To explore further on profitable Bitcoin analysis, please check out our live Bitcoin seminars and webinar events. The link access to the event platforms are listed in the description of this video below.